Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, everybody.
Hey, Lauren, this is part 2 of our summer series Back to School Erickson TV, and we're going to be talking about passive investing. So if you haven't seen the first episode, please go back to our archive to see that episode that explains passive investing. This episode we're going to talk about a couple legendary people that in the investment world that many people have heard of, that are an advocate for passive investing.
That's right.
One of them is Warren Buffett. Very well-known person, and he is interesting about him is he is talking about his estate plan, and he said that what he has put in his plan that if his wife survives him, his estate plan will recommend keeping 90% of her inheritance in the Vanguard S&P 500 fund and the rest in short-term bonds. Couple things. So what's your thought about that? Very simple. That's a very simple plan.
I think it speaks to Warren Buffett's consistency, which he has been consistent on this apparently since about the 1950s, that the average investor, the best thing that he thinks that they should do is just keep costs as low as possible, and also that they should invest in stocks, and that over the long run what you want to do as the average investor, in his words, is just take the returns that are there for the taking.
Right.
Don't think too hard about it, or his exact quote is something to the effect of, the moment dumb money realizes it's dumb, it ceases to be the dumb money.
Right.
It becomes the smart money.
Right.
So that's perfectly consistent with what he said for, I guess, 50 or 60 years now.
Yeah, very interesting.
So he hasn't changed.
Okay. Yeah, so that's good. So the thing about the second person is Charles Schwab. Charles Schwab is talking about how he noticed that there was a lot of people that got scared out of the last market downturn. So they're heavily endorsing indexing for investors who are nervous about the market. And so they're coming out with many more index funds. They're also coming out with something called the ETF, which is exchange traded funds. A little bit different than traditional index funds. Do you want to just spend a second talking about maybe an ETF versus an index fund?
I think the main difference between ETFs and index funds is that with an ETF, it's essentially traded like it's just a stock.
Right.
And so as a result, many people use ETFs for very, very, very short-term trading, which you really don't use an index mutual fund for. But if you just own an ETF and you don't trade it all the time, the differences between it and a regular index fund are much smaller.
Right.
It's mostly the actual behavior of people who own ETFs that's different.
Yeah, so kind of the end of the second episode, ETFs also are being promoted heavily by Fidelity.
Right.
My concern about ETFs is because there are many people that are doing rapidly short-term trading with them, and they can also be shorted. They could be bet against. It's a bet that with the purpose of the ETFs, maybe there may be a liquidity issue at some point.
Right.
So that was one thing that I always thought. Maybe there is a benefit of traditional indexes and structured indexes versus ETFs. Now, what Schwab is doing, which is causing me probably even a greater concern, Schwab is introducing sector-style ETFs.
Right.
And so they have the look and feel of passive indexes, but what they're trying to do is they're trying to dissect different parts of the market into small increments, or they're giving people a chance to actively try to pick and choose different sectors. And the biggest concern to me is that some of these sector ETFs have as little as only 20 stocks in the portfolio.
Right. That's not much. I mean, technically, yes, it's an index because technically you're just indexing that tiny little sector of the market. But what you've really got is what is essentially a fund with very little diversification.
Right.
And the real reason why these are being put out is for people to time the market. Very few people want to buy and hold an index fund that contains 20 stocks.
Right.
That's just very unusual.
Right.
So,
and so to finish out this episode, remember, if you look back at the first episode, Lauren talked about one of the advantages of passive investing is cost containment.
Right.
And also that you're going to capture over the long run market returns. Right. So it seems like some of these other strategies that Schwab is promoting in Fidelity are contrary to those thoughts. So, okay. Well, thank you for watching this episode of Erickson TV. We'll see you next time. Bye.
See you next time.